The Federal Reserve has shifted its thinking on interest rates. But what does that mean for you? Well, let me cut through the noise. It's not that big a deal. The commentaries around the Fed's shift have dramatized what should have been a reasonably well-anticipated move. Given the rapid rise in US inflation and the growing expressions of concerns from senior Fed officials, the shift by the Fed's FOMC on rate hikes should not have been surprising. Indeed, Eurodollar futures were already suggesting a month earlier the possibility of two 25 basis point rate hikes by end of year 2023. What the FOMC did last week was to shift the midpoint of its projections on rates from 0.1% by end of 2023 to 0.6%. But a month ago, Eurodollar futures had already priced in a 25 basis point rate hike early in 2023. So why should two 25 basis point hikes by end of that same year be so surprising? What does this mean for markets? Well, the equities market will get over this. A correction in US equities was logical, particularly given they were technically overbought anyway. But as long as US economic and earnings growth continue as expected, stocks should hold up. However, the shift in thinking on rates is more dangerous for bonds. The 10-year US Treasury yield is already mean reverting from a historical low from March of last year. And at its current 1.5%, it is still a long way from its 10-year mean of 2.1% and its 10-year cycle tops of around 3% to 3.2%. Investment-grade credit spreads are at their tightest in some 24 years. High-yield spreads are at their tightest in some 14 years. What this simply means is great risk of spread widening, which could destroy mark-to-market bond prices. For the US dollar, this is near-term positive, but longer-term, there remains more downside risk. The US dollar index, the DXY, was already in a rebound from late May, and the Fed's shift in thinking gave it a boost on the way up. Given its 10% decline from its year 2020 high, further gains can't be ruled out. But longer term, if the Fed suppresses the 10-year US Treasury yield, allowing inflation yet higher in pursuit of full employment, the real yield on the 10-year US Treasury will erode, potentially damaging its appeal versus other currencies, particularly if other central banks let their government bond yields